It's a Sunday afternoon and you're sitting across a desk from a mortgage officer. He's pleasant, professional. He has a printout in front of him with your name at the top and a number at the bottom, the amount the bank is willing to lend you. It's larger than you expected, larger, honestly, than feels entirely comfortable. But he's smiling, the process feels official, and there's a quiet social pressure in the room that makes asking hard questions feel like ingratitude. So you don't ask the hard questions. You sign where they put the tabs. You shake hands, you get the keys. And somewhere in the weeks that follow, after the moving boxes, after the first utility bill, after the first time something breaks and you realize there's no landlord to call, a number starts to form in the back of your mind. Not the purchase price, not the monthly payment, the actual number. What this house will cost you by the time you own it. Most people never calculate that number before they sign. The ones who do are often genuinely shocked by what it says, and the ones who understand what it means, not just the total, but the mechanics behind it, the traps embedded in the structure, the decisions available to them that nobody mentioned in that office. Those are the buyers who end up in a fundamentally different financial position 20 years later. My name is William. And today we're going through everything the mortgage industry would prefer you didn't fully understand before you committed to the largest financial obligation most people will ever sign. First, the number nobody shows you at closing. The purchase price is the number on the listing. The monthly payment is the number the bank shows you. Neither of them is the number that actually matters. The number that matters is total repayment cost. On a $350,000 home with a 20% down payment, you're financing $280,000. At a 7% interest rate over 30 years, your monthly principal and interest payment is approximately $1,863. That number feels manageable. It's supposed to feel manageable. The monthly payment is the number the entire mortgage industry is optimized to make feel acceptable. Here's the number nobody puts in the folder they hand you at closing. Over those 30 years, you will make total payments of approximately $670,000 on a $280,000 loan. The interest alone, the cost of borrowing the money, is roughly $390,000. You borrowed $280,000, and you're paying back $670,000. The bank collects more from your house than you paid for it. That is not a criticism of mortgages. For most people, home ownership still makes financial sense when the alternative is renting indefinitely. But the decision to sign should be made with the real number visible, not the monthly payment that was engineered to feel like a reasonable Tuesday. Understanding the total cost is step one. Understanding how that cost is structured is where the real leverage lives. The amortization trap, why your first 10 years of payments are almost entirely interest. Most people assume that when they make a mortgage payment, a meaningful portion goes toward paying down what they owe. The reality of how amortization works is considerably more lopsided than that assumption. In the early years of a mortgage, the overwhelming majority of each payment goes toward interest, not principal. On that $280,000 loan at 7%, your first monthly payment of $1,863 breaks down to approximately $1,633 in interest and $230 toward the actual balance. Month 1, you paid $1,863 and reduced what you owed by $230. By year 5, you've made 60 payments totaling over $111,000. Your remaining loan balance, approximately $262,000. You've paid $111,000 and reduced the balance by $18,000. The other $93,000 went to the bank as interest. This is not a glitch or predatory practice. It's how compound interest works when structured in the lender's favor over a long term. But it has a critical implication that most borrowers don't act on. Extra principal payments made in the early years of a mortgage are dramatically more powerful than extra payments made later because they eliminate years of interest that would otherwise compound on top of them.
A single extra principal payment of $200 in month one eliminates significantly more total interest than $200 paid in month 200 because the early payment removes the base on which years of future interest would have accumulated. The math on early extra payments is one of the most accessible wealth-building tools available to any homeowner, and one of the least used because nobody explains why early matters so much more than late.
What your interest rate actually costs over time. The difference a single percentage point makes. People negotiate over fractions of a percentage point on a mortgage rate the way they'd negotiate over a few $100s on a car price, with some interest, but without full appreciation of what's actually at stake. The difference between a 6.5% and a 7.5% mortgage rate on a $300,000 loan over 30 years is not a small number. At 6.5%, your total interest paid is approximately $382,000. At 7.5%, total interest reaches approximately $455,000. 1 percentage point costs $73,000 over the life of the loan. A half-point improvement, going from 7% to 6.5%, saves approximately $37,000. That is not a rounding error. That is a car or a year of college tuition, or invested at 7% annual returns, roughly $145,000 over 20 years. This is why your credit score in the months before a mortgage application is worth obsessing over. The difference between a 680 and a 760 credit score typically translates to 0.5 to 1.5 percentage points in mortgage rate, depending on the lender and market conditions. On a $300,000 loan, that range represents $37,000 to over $100,000 in total interest. The ROI on spending 6 to 12 months improving your credit score before applying for a mortgage is one of the highest available to anyone planning to buy a home. The down payment decision, what 20% actually buys you. The 20% down payment threshold exists for a specific reason that the industry communicates poorly. Below 20%, lenders require private mortgage insurance, PMI, which typically costs 0.5 to 1% of the loan amount annually. On a $280,000 loan, that's $1,400 to $2,800 per year, between $115 and $233 per month, for coverage that protects the lender, not you. PMI disappears once your equity reaches 20% of the home's value, but you have to request its cancellation in most cases. It does not automatically drop off at the threshold on many loan types. Homeowners who don't know this continue paying for coverage they no longer need, sometimes for years after they've crossed the equity threshold that eliminated the lender's requirement for it. The down payment decision involves a second consideration that runs in the opposite direction. A larger down payment reduces your loan balance and your interest cost, but it also removes capital from your liquid assets. The $60,000 you put toward a larger down payment is $60,000 that isn't in your investment account compounding. Whether the guaranteed interest savings outperform the potential investment returns depends on your interest rate, your expected market returns, and your time horizon. At a 7% mortgage rate, the guaranteed return on additional down payment in the form of avoided interest is 7%. At historical stock market average returns of 10% annually, keeping the money invested and carrying the larger mortgage can produce better outcomes over long periods. At lower mortgage rates, the math shifts more clearly towards investing the difference. There is no universal right answer. There is a calculation worth running before you commit to either direction. The 15 versus 30-year decision. What the payment difference actually buys. The monthly payment on a 15-year mortgage is significantly higher than on a 30-year mortgage for the same loan amount. That payment gap is why most buyers default to 30 years. The lower payment feels safer, more manageable, less financially exposed. Here's what the 30-year choice costs. On a $280,000 loan at 7%, the 15-year payment is approximately $2,516 per month. The 30-year payment is $1,863. The monthly difference is $653. The total interest difference over the respective terms is approximately $225,000.
The 30-year mortgage costs roughly $225,000 more in interest than the 15-year on the same loan. Additionally, the 15-year mortgage typically carries a lower interest rate, often 0.5 to 0.75 percentage points below the 30-year rate, which compounds the savings further. The counterargument is the same one that applies to down payment decisions. The $653 monthly difference invested consistently in an index fund at 10% annual returns over 15 years produces approximately $250,000, which slightly exceeds the interest savings from the 15-year mortgage. The 30-year mortgage with disciplined investing of the payment difference can mathematically compete with the 15-year payoff, but only with the investing actually happening consistently, which behavioral research suggests is the variable most people overestimate their ability to maintain. The honest version, if you have the discipline to invest the difference every month without fail, the 30-year gives you flexibility that can produce comparable outcomes. If you have any doubt about that discipline, and most people should, the 15-year mortgage forces the outcome automatically. What happens if you just pay a little extra every month? This is the most underutilized financial lever available to any homeowner, and it requires no refinancing, no special arrangement, and no financial sophistication to execute. Adding $200 per month to the principal payment on a $280,000 mortgage at 7% reduces the payoff timeline from 30 years to approximately 24 years, 6 years eliminated. Total interest savings approximately $89,000. Adding $500 per month cuts the term to roughly 20 years. Interest saved approximately $150,000. The extra payment goes directly to principal, skipping the interest calculation entirely, which means it eliminates all the future interest that would have accumulated on top of that principal. This is why small extra payments in the early years produce disproportionate savings. They remove the foundation on which a significant chain of future interest would otherwise compound. The practical implementation is simple. Set up an automatic additional principal payment the same day your regular payment processes. Not a number you'll think about and decide on each month. A fixed, automatic amount that reduces the balance without requiring a monthly decision. The decision made once is the one that actually sticks. The mortgage is the largest financial commitment most people make, and it's typically made in a room designed to move quickly, with a pleasant professional, a folder of documents, and a social dynamic that makes slowing down feel impolite. The buyers who understand what they're signing before they walk into that room, who know the real repayment number, who understand amortization, who've optimized their credit score, who've run the 15 versus 30-year calculation, who know what PMI is and how to get rid of it, those buyers make different decisions. Not necessarily different houses, different terms, different structures, different total costs. The monthly payment is what the mortgage feels like. The total repayment cost is what it actually is. Know both numbers before you sign either.